Hello friends and welcome back to our channel Smart Traders Club. In today's video, we'll discuss about the technique how to select right strike price for the profit. When you're talking about the right strike price, definitely we can relate it with the option trading. And when we are talking about the option trading, there are two kinds of traders available in the market. One who buy option, another who write options. So definitely selecting right strike price is applicable for both of them. But since we are more of the option buyer than the option writer, so our focus will be more towards the option buying in entire video. So if you are an option buyer or an option writer, definitely this video will help you out in selecting the right strike price. But focus or the examples taken in this example is in this video is as per the option buyers. So let's move ahead, and before I move ahead, if you guys are okay with the English, you can continue with this particular video. But if you want to listen or if you want to view this video in Hindi language, then you can see or you can click on the I button. The same content is uploaded in Hindi language also. So let's move ahead with the main content. So this particular slide we have already covered in our previous video, but just to revise it or just to make you on the same page, there are two kind of options available in the market: call option and put option. When you look at the call option, normally you can see like mention as CE, and when you look at the put option, they mention as a PE. So basically you will get like Nifty Jan 12,500 call option, Nifty Jan 12,000 put option. This is what the PE and CE denotes actually. When I'm bullish on the market, or let me say when I'm strongly bullish on the market, then in that case I buy call option. When I am strongly bearish on the market, then in that case I can buy put option. At the same time, when I feel and I have good margin, then when I feel that market will not come up, market will remain sideways, or either market will go down, then in that case I can sell call option. And in case if I feel that market will not go down, market will remain sideways, or market will come up, market will move up, then in that case I can sell put option. So when to buy call option? When I'm strongly bullish. When to buy put option? When I'm strongly bearish. When to sell call option? When my opinion is like market will not come up, market will remain sideways, and if I feel market will remain sideways or market will move up, then I can sell put option. Then in that case, the important characteristics or the important thing which we should be aware about, in case if you are selling option, then there are chances of the unlimited loss, which can be controlled by keeping stop loss in market or in order basically, and limited profit. But when you are buying an option, there are chances that you can get huge profit and at the same time limited loss. This particular statement, limited loss, is replaced in some of the strikes as the unlimited losses also, because there are few instances where people have paid 35 lakh rupees for just buying an option, which is stock option. So this just because of the delivery options, or let me say delivery criteria available in the options. So we'll discuss about it later on, not today. Let's move to the main content of today's video, which is selecting the right strike price. So how to select it? I'm just taking an example here. Let's say I'm bullish on the market and I feel Nifty will move from 12,400 to 12,226, and in that case I have two options: either I can buy call option or either I can sell the put option. And I'm taking example here which is expiry 9th Jan 2020. Now you may have discussion in your mind, why am I taking this expiry of 9th Jan 2020 and 12,400, 12,226? Because I'm making this video on the 30th Jan 2022 and market is around 17,100, Nifty is around 17,100. The reason behind that, let me show you the option chain. If you look at this option chain, you can see the prices are inflated here. Why I'm saying inflated? Because of the budget. We are expecting budget on the 1st of February, so definitely you will see IV is on the higher side. So if you look at the IVs is 43, 42, 44, which is higher side basically. Because of that, if you look at the money price, so 17,100 is quoting somewhere close to 392. If you look at this particular option chain, which is the same expiry which I've just discussed about the Jan 2020, the IV is around 7.96, 8.9 and 7.78, and at the money is around 75 rupees. So this is what the difference IVs make in the price of options. If IV goes up, then in that case prices will move up this particular option is costly, then in that case, and if IBs are down, then definitely you will get prices on the lower side. So why am I taking this example, which is 12,400, 12,226? There is two reasons behind this. First reason, yes, this particular example was available in the Hindi version of this particular content of video, so I have taken the same example. And second thing, the technique which we are talking about is applicable only and only if your IV is from 5 to 20. If your IB is above 20, definitely this particular technique of selecting the right strike price will not be applicable. So I've taken this example, and allow me to take this example. Let's move ahead now. So since I'm talking about 12,400, 12,226, so let's say I have got this strike price which I can buy: 12,200, 12,300, 12,400, 12,500, 12,100 and 12,000. So these are the strike price which I can consider if my view is from 12,226 to 12,400. The current market price of 12,200 call option is 75, 12,300 is 29, 12,400 is 7, the 12,500 is 2, and 12,100 144, 12,000 is around 234. Lot size, current lot size, I've considered the current lot size which is 50, and if I have to buy one lot of it, then the cost will be around 75 multiplied by 50, which is 3,750. And same way I need to multiply this. So if I multiply 2 into 50, definitely it comes to 100. So to buy one particular lot, I need to pay this much amount of the call. I'm buying the Nifty call. Here I'm taking example of Nifty. So Nifty call option 3,750 for the 12,200. For 12,000 I need to pay 11,700 amount. Let's say my view is right and market expired somewhere close to, or let's say exactly on the 12,400. If this happened, then in that case the cost or the price of this 12,200 will be 200 at the time of expiry. 12,300 cost will be around 100, and since 12,400 and 12,500 though will be out of the money, though 12,400 will be at the money, but since it does not have any intrinsic value or time value is already 0, so the price will be 0, and 12,500 will also become 0. 12,100, it's in the money, definitely it will, the cost or price will be around 300, and for 12,000 price will be around 400. So what will be my profits since I have brought one lot of each, or let's say one lot of any of this strike price? In case if I've got 12,200, then my profit is 6,250 rupees. In case if I've brought 12,300, then my profit is 3,550 rupees. 12,400 and 500, since it is almost out of the money or at the money, because of that I've lost entire amount here. The investment amount 350 and 100, I've lost entire amount here. 12,100, I have made profit of 300, the cost was 300, so definitely the profit will be around 7,800 because I have paid 144 rupees, and for 12,000 strike my profit will be around 8,300. If I look at absolute number, then in the absolute number I can see 12,000 is giving me higher profit, which is around 8,300. So just by looking this particular data, I can say that I must have selected 12,000, which will be deep in the money to get the maximum profit. But what we need to understand here, look at the cost also. We have paid 11,700 to get this particular 8,300 as a profit. So let's look at the percentage return. If you look at the percentage return, it simply says that in case if you have brought 12,000, then the percentage return is around 71%. In case if you have brought 12,100, the percentage return is around 108%. In case of 12,300, it is 245%, and in case of 12,200, it is 167. And the prices, or let's say the current market price of Nifty is 12,226. So look at the moneyness, why it is happening, because the 12,200 is in the money. Why I am saying this is in the money, because I don't consider 12,250 or let's say 50 ka multiple, I don't consider in Nifty. 12,300 will be out of the money, 12,400 will be out of the money while purchasing this particular options. When Nifty was 12,226, that time 12,500 will be deep out of the money, 12,100 in the money, and 12,000 is deep in the money. So looking at this particular data, we can understand one thing. in case if your IVs is between 5 to 20, then it's better to go either with the immediate OTM. So in this case 12,226 was the price, 12,300 is the immediate OTM, or either immediate in the money, so which is 12,200. But selecting deep in the money or in the money is not the right option, not the right choices to make the right profit. When I'm talking about in the money, out of the money, let me differentiate that also in case if you're not aware about it. What is in the money? In the money is nothing but I'm talking about the call option here. So let's say your spot price minus strike price is positive, then in that case for the call option, then in that case it is in the money. So let's say your spot price is around 12,000 and your strike price is around 12,000. Let's say it is 12,200 and your strike price is around 12,000. So if you deduct it, you will get 200 as a point. So definitely it is in the money. What is OTM, or let's say what is ATM? The nearest strike price to the spot price is the ATM. So your 12,200, if Nifty is trading around 12,200, my 12,200 will be the strike price and spot price, both nearest one. So that is my at the money. What is OTM? OTM is nothing but, let's say if your spot price is around 12,200, I'm really sorry, I don't know why this pen is not working fine, and strike price is around let's say 12,400, so I will get minus 200 as the negative point. So definitely for call option that will be my OTM, and this is exactly opposite in case of put option. So in case of put option, if my spot price minus strike price is negative, so 12,200 minus 12,400, so if it is negative then it is in the money, and if it is positive then in that case it is out of the money in case of put option. So we have taken this particular example where we have come to a conclusion that in case if you want to buy call option or even a put option, if you want to buy, and if your IVs is between let's say 5 to 20, then in that case selecting immediate OTM or immediate in the money will be the right choice. Thank you very much for watching this video. That's it from this particular video. Hope you have enjoyed it and you liked it also. In case if you liked it, please share with your friends too, so that even they can watch it and they can get benefit out of it. Thank you very much again for watching this video. Keep learning. Bye bye.